I think that, so your first strategy is you put your balance sheet into Bitcoin as much as you dare, right? And your second strategy is you try to tie your P&L, your products and your services into Bitcoin. Look, if you're on television, talk about Bitcoin, put it on the screen. If you're an analyst, analyze Bitcoin versus gold and every other asset class. If you have a mutual fund company, you should offer mutual funds based on Bitcoin. If you're an insurance company, you should offer Bitcoin-backed life insurance.
Mm-hmm.
If you're a mobile payment company like Square or PayPal, you should build Bitcoin into your mobile payments. But I would not recommend that anybody take liquid capital and go into business competing against Square or PayPal. I would not recommend that you go into business competing against Fidelity or PIMCO. I would not recommend you compete against CNBC. You should use your strategic assets that you have accumulated over 30 years and align them to the new reality of Bitcoin. But you should, if you have liquid capital, you got $10 million in capital, just buy the Bitcoin because it's the most competitive ecosystem ever. When I talk to entrepreneurs that are investing in Bitcoin, they're like, I just raised $50 million and I'm going to do Bitcoin, whatever, something, hard wallet or something. I said, well, have you invested half of that in Bitcoin? They're like, well, wait a minute. I need to keep that in US dollars in order to compete. I'm like, you're crazy. The US dollar is losing its value. There's a future where your company fails and Bitcoin succeeds.
Yeah.
In fact, it's 99% likely that any company competing in a competitive market fails, but the market succeeds. So if you want to de-risk your company, I would say invest your treasury in Bitcoin and you'll succeed whether or not you become the world's greatest mobile payment network on Bitcoin or the world's greatest Bitcoin miner. In fact, I tell the miners, I said, buy Bitcoin before you mine Bitcoin. And that's what Marathon did. And they made $150 million off of the Bitcoin they bought before they mined the first 150 million in Bitcoin. And so it's a smart idea to put your balance sheet into Bitcoin before your P&L. And so let me give you a model to think of. My company had 500 million in revenue. We generated 75 million in cash flow, and we had 500 million in cash on our balance sheet. And that 500 million in treasury was yielding effectively zero. Well, if the money supply, the cost of capital is zero, you can tread water. When the money supply when the cost of capital got to be 20%, and I saw this in June, I said, well, if I work hard and I do 100,000 things right for a year, I'm going to generate 75 million in cash flow, but I'm going to burn 100 million in shareholder value. And so in essence, all of the work of everybody in the company is irrelevant because of the monetary wind blowing in my face. So it's kind of like you're in a rowboat and you're rowing 5 miles an hour against a 5 mile or 2 mile wind, and you're rowing across the Atlantic. The wind starts blowing 20 miles an hour in your face. You're getting blown back 15 miles an hour. You're never going to get across the Atlantic. You're going to starve to death. So what do? Well, you take your 500 million in capital and you convert it into a $500 million Bitcoin sale. Okay. And then you turn your boat around and you sail with the wind, not against the wind. And now, if you have $500 million of Bitcoin against a 20% cost of capital, you're going to generate $100 million in investment income plus 75 million in operating income or cash flow. And so you just doubled the value accretion of the company. Well, when we got to the point where that crypto sale became $1 billion sale, and we knew we were going to generate a $200 million investment income by doing nothing, just getting blown with the wind. And now you're a company that's going to generate $250 million of accretion a year against 500 million in revenue. What happened next? We borrowed 650 million. We forward financed the next $650 million worth of cash flow, bought Bitcoin, doubled it, and we ended up with a $3 billion crypto sale. And if that gets blown at 20%, then you're looking at $600 million in investment income And what do you do next? Well, we got blown a bit further. We raised another billion at 0% interest. We're basically borrowing money at 0% interest, $1 billion for 6 years. And we're buying an asset which is appreciating in value 200% a year. The arbitrage is 200%. It's pretty obvious. So what happens next? Well, Bitcoin is going up because it's the strongest asset out of $400 trillion of weaker assets that are all bleeding 15% of their monetary energy a year. We now have, and Guy, I can't make this up. This is like unbelievable. Last year, we had $500 million as a liability yielding 0, and it was hopeless. It was literally hopeless. Nothing we could do is going to actually create shareholder value. The stock traded down to $90 a share. It was maybe trading at 100. We were being valued at 1 times revenue plus cash. That was the situation. Today, we have more than $5 billion in assets in Bitcoin, $5 billion. And if the money supply gets expanded by 20% or by 15%, you're looking at generating $1 billion of investment return a year, just waiting. And so you got to say, you got to get out of your rowboat where this is Main Street versus Wall Street, K-shaped recovery. On Main Street is 2,000 people doing 100,000 things perfectly, working as hard as they can against a monetary wind blowing in their face, against tech monopolies, Microsoft, Apple, Google, Amazon, with all their hands tied behind their back. That's Main Street. Wall Street is, I have $5 billion. And if the Fed continues with their loose money policy, then we'll make $1 billion and we'll do it with 1/4 of a person. And so the bottom line is, if you're a company, you have to have a balance sheet with high quality assets that are going to appreciate at a value rate faster than the rate of monetary expansion. Otherwise, you're simply being beat to death by the monetary policy. The most important takeaway for a corporation is if the cost of capital is 8% or 6% and you can get 4% on conventional treasury strategies, then you can go ahead and pursue that. But conventional treasury strategy is broken. The cost of capital is 20% or more. Conventional treasuries yield 0. You got to find a different strategy. Securities are a bit problematic for a corporation because of the 40 Securities Act. And, do I want to hold more than 40% of my balance sheet in securities? And it's tricky, but one solution is I buy the S&P or I buy NASDAQ, and maybe. The other solution is I buy property, and the highest quality property is Bitcoin. So the big idea is convert your balance sheet from a liability into an asset, and either do it to avoid destroying all the shareholder value in your cash and in your treasury, or do it because the alternative, Guy, is actually more horrifying. The alternative is maybe I'm growing my company 8% a year, but I know I got to grow it 16% a year to get respect from Wall Street.
Right.
So I borrowed billions of dollars and I buy half my stock back.
Yep.
And so I take on billions of dollars of debt. I leverage up. I get my cash flow per share to grow 16% a year instead of 8%. And then I get some respect from Wall Street. I'm now $2 billion closer to insolvency. And what I'm doing is I'm borrowing large sums of money to buy a business that's growing 6% a year. And I'm eliminating all the equity. The opposite idea, and by the way, this is kind of what Apple is doing. I mean, Apple's a great business. It's literally a digital tech monopoly. So it's not a scary idea for Apple. But there are plenty of businesses that are not digital tech monopolies that can't issue a product to 1 billion people over the weekend for a nickel. And when those companies pursue that, they're basically giving up all their equity and they're taking on huge leverage, and they become like a Toys R Us situation where they're driven toward insolvency because they can't compete. So there's a different strategy, right? By the way, this is the road less traveled. We had a choice. We could give back $500 million to the shareholders, and we would have basically twice as much MicroStrategy, and we could try to grow at 5% a year, you know, and everybody's like, if you tell everybody you're going to grow a company 5% a year, they roll their eyes and they think, and their message to every CEO is, you got to take on more risk. You got to do something. You got to do an acquisition. CEOs are driven into massively leveraged positions or dilutive acquisitions in order to please Wall Street. And Wall Street's not the evil enemy, or the problem is the cost of capital is 20% or 15%. So you're either going to pursue a strategy of dilutive acquisitions or a strategy of excessive leverage, or your third strategy is Apple could borrow $25 billion at 1% or 3% interest, buy Bitcoin that yields 200% interest. And it's what would you say to Tim Cook? You would say, Tim, if you can buy a $100 billion company that's growing 100% a year and is profitable, you should do that.
Right.
What is Bitcoin? Bitcoin is 100 billion, you know, you can buy $100 billion worth of Bitcoin or 10 or 20 or 30 billion worth of Bitcoin. It's growing 600% this year, but 200% a year on average. So my message to any company, whether it's Microsoft or Amazon or Apple or Tesla, is why don't you take the asset that you can get a lot of? You can go borrow $20 billion worth of capital at 3% interest. And why don't you go do an accretive acquisition? And an accretive acquisition is something growing 100 or 200% a year. By the way, what's better, for Apple to buy Disney or for Apple to buy Bitcoin? Because if you buy Disney, you're buying 100 million moving parts and a lot of complexity and a lot of risk and a lot of competition. If you buy Bitcoin, your treasurer just had to go buy Bitcoin. There is no competition. There is no employee base, right? There is no, the moving parts have all been worked out for a decade. They're not changing. So it's a much better balance sheet idea than what's being laid on the table for most CFOs or most CEOs right now.